Hi, everyone. This is Jared Levy, Director of Investment Management here at DBHW, joining you from the Belleville, Texas office. I wanted to just spend a couple minutes here, talk about what we're seeing in the markets, the economy, and what we see coming up potentially for the future. So far this quarter, as you all know, it's been a volatile one. Stocks have entered what we call correction territory. And basically what that means is anything below a 10% pullback, investors tend to call that a correction. Just note, very, very normal. This is very typical. And it's actually what you want to see. It's signs of a healthy market when stocks pull back and kind of reset. Obviously, the presidential election was a big catalyst for that. Again, this isn't about being political or choosing right or wrong. What we do know is the president has enacted an immense amount of executive orders to get things done on his agenda. And while we believe that a lot of those things are going to be a net positive for the economy, as analysts and economists and investors try to figure out the impact, specifically around tariffs, which we know have been a big thing, that can shake up markets. And again, remember, markets don't like uncertainty. It's very hard for markets and investors and us as consumers to figure out what's happening when we're uncertain. So that's what we're seeing right now. Now, again, it doesn't mean you run away from the market and forget all about it. But I will say that riskier stocks, those high-flying tech names, the Alphabets of the world, Netflix, Nvidia, a lot of these sort of what we used to call the Mag 7, and they still do call the Magnificent 7. Those are 7 stocks that ran the market basically last year. Those types of stocks are going to be closely scrutinized here, right? Think about it. If you're high flying, if you're expensive, investors want to know that you're doing well. So if those stocks don't pass the muster during their earnings reports, which occur once every quarter, investors may react a little overly strong in terms of their selling. So again, we see higher risk with those names. And with that, if you're a conservative investor, probably best to sort of look for some alternatives or just be prepared for some of that increased volatility. Investors overall have moved to a risk-off stance. So what does risk-off mean? That means basically moving into defensive names. When I talk about defensive, think about utilities companies, right? Also companies like Johnson & Johnson, consumer staples, things that we need and use every day. If you're one of those companies that produces those sorts of things or provides those kinds of services, those are defensive companies, again, tend to be a little bit less volatile, and that's where investors have been moving their money to. Obviously, gold has been a big boon, a big beneficiary of the uncertainty, which historically it is. Investors flock to gold when they're seeking what's called a safe haven, if they're concerned. And gold has hit all-time highs here in the first quarter of 2025. We see continued strength in gold, but that doesn't mean that gold's not going to have its own pullbacks. But right now, defensive names, gold, and bonds, right? Fixed income, namely high quality bonds such as U.S. Treasury bonds, are also getting some love from investors who are a little concerned about, the future of the U.S. economy and the health of the U.S. consumer. So let's talk about the consumer for just a second really quick here. Again, our economy at the top line still looks good, right? The overall unemployment rate is low. Growth remains here. GDP is right around 2.4% or so. Okay, so overall, that looks good. But again, if you look down to the details and if you turn to Main Street, things aren't all rosy. There are some risks out there. One, inside of the labor market, inside of that jobs market, we have seen a huge slowdown in hiring. We've also seen an increase in layoffs. Okay, that is a sign, an early sign that there are some cracks in that foundation. That's one thing we're watching closely. The other thing we're watching, again, just plain and simple, are consumer confidence and small indications that the economy itself has already begun to slow. Now, is it slowing to the point of failure? Well, we don't believe that. Okay. What we do believe is that we're being overly cautious here and careful as we move forward, because again, there is an increased probability, we believe, of recession. I'll talk about that in just a second. And again, no need to panic there at all. I'll explain what all that means. Okay. High costs continue to eat away to Americans' pockets. I'm sure you all know, and I know this, you've heard this a million times, but go to the grocery store. Things are expensive. Thank goodness fuel prices have come in. That's been a help. But things you pay for every day, getting your home repaired, having electrical work done or landscaping work done, all those prices have reset higher and wages haven't really caught up. So again, people are spending a lot more because of that inflation. We think that that's going to unfortunately stick around. So that's led to consumer confidence coming down. And when consumer confidence comes down, you just don't spend as much. I mean, think about it. If you just lost your job or were in fear of losing your job, you wouldn't be spending either. So that's what we see is happening here. Again, I want to stress, it's not everything's falling apart and we should all be panicking. No, we're just seeing risks that are slowly building. And for you as an investor, it means change, some of your strategy. Maybe you change some of your spending habits already at home. For us as investors and as fiduciaries for you, in our accounts, we've again taken a more defensive stance, moved into lower volatility strategies in the right cases, moved into some more defensive names, scaled back some of the risk overall in the portfolios. And again, as long-term investors, really critical here, guys, keep yourselves invested. Stay the course. One of the biggest risks that we see to people not attaining their financial goals is the fact that a lot of people try to time the markets. They jump in, they jump out. Markets sell off, they get out because they're panicked. And unfortunately, none of us have a crystal ball. The key is stay invested, stay risk appropriate. In other words, stay invested in things that meet your risk goals, your risk tolerance, and how much money you need, not just for your retirement, but maybe, for your savings, for your kids' school funds, whatever it may be. Make sure that you're appropriate there. So what do we see moving forward? Well, again, like I said, riskier stocks probably going to struggle here. We do believe that investors will continue to move to what we call high quality value companies. Again, what that means is not the most popular companies everybody's talking about. Maybe investors are going to start looking at more of the names of the companies or the companies, I should say, that aren't in the news. These are the companies that provide infrastructure for the U.S., that help America grow, that help keep our country running. Again, think about utilities, think about some manufacturing, think about all of the infrastructure that we need for EVs and even for regular cars, even our electrical grid. Those are the areas that we're looking towards, okay? Around the world, we're also seeing a reduction in globalization. What does that mean? Basically, simply put, countries like the U.S. are looking within their own borders. We're looking here to produce more onshore, to have more services here, and to consolidate our businesses within the U.S. borders. Obviously, we still have to trade with partners. There are still things and resources that we need from people like Canada, yes, from people like China, yes, and Mexico and all of the things. As much as we want to have everybody paying their fair share in tariffs, at the end of the day, countries are moving towards self-sustainment as much as possible and protecting their borders and their rights. So we're getting a little bit more tactical here. We're looking again at different strategies that are more risk appropriate. We're scaling back on risk in certain areas. And again, looking domestically for strength. We will still invest overseas in some cases, but again, being really careful and surgical about how we do so. We do think that market turbulence will continue. And we do see, as I said, an increased risk of a very shallow recession. And in fact, some would even argue that the current administration wants to almost engineer a shallow recession. Why would they want to do that? Why does that make sense? Well, in a recession, interest rates decrease, they come down. And if you're a homeowner or you've got credit cards or you've got personal loans, interest rates coming down provides you with some relief. And it'll provide the rest of the economy with some relief. So in a sense, as much as the word recession can be bad, when you're in a period of high interest rates like we are right now, recessions may actually be a good thing for a short period of time anyway. Regardless, it is important that you know that your assets and your wealth are well cared for here at DBHW. We take our work very seriously. We take the markets very seriously, and we take you, your family, your legacy, and your wealth very seriously. If you have any questions about your portfolios, please contact your advisor. We'd love to talk to you, walk you through. And again, don't be afraid out there. Stay the course. My name's Jared Levy. Have a great day.